Welcome to the Chapter 9 tutorial on receivables. In Chapter 9, we're first going to look at accounts receivable. And we learned that an accounts receivable is basically an amount that our customer owes us for services or products that we've already provided them. Now, the one thing the textbook talks about is the difference between a control account and a subsidiary account. And when it comes to accounts receivable, most accounts receivable will have a bunch of subsidiary accounts. And what I mean by that is, let's think about this T account. Let's say we have $100,000 in our accounts receivable balance. Now, we know that that likely is made up of a bunch of smaller accounts. It's not just one customer that owes us the 100,000. So in the main general ledger account, we're going to have 100,000, but in what we call our subsidiary ledger, we're probably going to have a bunch of smaller accounts that make up the 100,000. So in our subsidiary ledger, we might have one customer that owes us 80,000 and another customer that may owe us, customer number 2 that owes us the 20,000. So we know that the total in the subsidiary ledger always has to equal the amount that's in the main control account, which is part of our general ledger. So that's what we mean by subsidiary ledger, is that the main account, the control account, 100,000 accounts receivable, is likely made up of smaller amounts, and we keep track of those smaller amounts in our subsidiary ledger. So that's sort of the first thing that the textbook talks about with respect to accounts receivable. Now, we have to think about, why would a company provide customers with credit? So let's talk about some advantages and disadvantages of providing credit to our customers. Well, when we talk about advantages, one of the main advantages is that if we provide credit to our customers, that will likely increase our sales. Customers can buy the product from us today, but we may give them 20 or 30 days to pay it off. And so it likely will increase sales, and it will help us remain competitive. If all of our competitors are providing credit to their customers, in order to remain competitive, we have to provide credit as well. But obviously there's some disadvantages. And one of the main disadvantages is that there's a cost of collection. So if our customers do not pay us within the 30 days, for example, then one of our employees is going to have to follow up and try to get them to pay. So there's a cost of trying to collect the amount if the customer doesn't pay us. There's also a delay in collecting the cash. So the delay in cash receipt. We make the sale today, but we're not going to get paid for 30 days. And so there's going to be a delay in cash. And meanwhile, we have to pay for all of our inventory purchases and all of our expenses. So that's a big disadvantage to providing credit to our customer. And then the final disadvantage is that we may never get paid. What if our customer that we made the sale to goes bankrupt, and so we may never get paid, and so we could lose a bunch of money. And so that's what we're going to focus on today, is what happens when we have uncollectible or doubtful accounts receivable? What if customers may never pay us? How will we account for that? We've recorded the sales revenue. How will we record this amount that we may end up losing? And that's where we're going to get into a couple of new accounts. Now, the loss that we will face, the amount that we may never collect, we're going to create this new account called bad debts expense. And so bad debts expense is an expense on our income statement, and it's going to relate to the amount that we think we may never collect. Now, bad debts expense is going to be an estimate. And the reason it's going to be an estimate is that it's going to take a long time to determine which customers will never pay us, because even if we give them 30 days, we may still try to collect from them, call them up, send them some notices that if they don't pay us, we're going to take action. But that could take time. And so when we record this new expense called bad debts expense, we have to record that expense in the same period that the sale was generated. So if we made the sale in the year 2020, then all those credit sales in the year 2020, we're going to have to record an amount called bad debts expense that estimates the amount that we think we may never collect. Now, we're also going to have this new account called allowance for doubtful accounts. And let me just actually give you an example here. Let's say our accounts receivable is $100,000. And let's say this is all at year end. So let's say this is at December 31st at our year end, and we have $100,000 in accounts receivable. Now, in order to record the bad debts expense, we have to make an estimate. And let's say we estimate our bad debts expense, and expenses are always recorded with a debit, to let's say be $2,000. So we estimate that out of this $100,000 in accounts receivable, we think $2,000 will be uncollectible. So we recorded bad debts expense of $2,000. Now the question is, when we record this adjusting journal entry, we're going to debit bad debts expense for $2,000. The question is, what do we credit? Now, if we put the $2,000 here, we're going to have to get rid of a specific accounts receivable, right? Because you remember up here, we said that our control account must always equal our subsidiary ledger accounts. If we take off $2,000 from our accounts receivable, that means we have to take off $2,000 from one of these accounts. And we can't do that because there's a good chance that they will still pay us. And so what we have to do then is we're going to set up what we call a contra account. Now, we've dealt with contra accounts before. A contra account is connected to the main account. The main account is going to be accounts receivable. And we're going to set up this contra or companion account called allowance for doubtful accounts, or ADA. Allowance for doubtful accounts. And we'll see this term throughout chapter 9. And we're going to put the $2,000 here. And so we're just going to set it up so that the credit will go to this new account called allowance for doubtful accounts, and it's not going to affect our main accounts receivable account. And so at the end of the year, we're going to be reporting our accounts receivable net to be $98,000. $100,000 is our total accounts receivable. We estimate that $2,000 will be uncollectible. Remember, that's only an estimate. And so our net accounts receivable is going to be $98,000. Now, this relates to a couple of principles. The first principle is called matching. We're matching our bad debts expense in the same year that we made the sales revenue. And so the matching of expenses with revenue is critical to accounting. So we have to estimate our bad debt expense this year because it's going to relate to the sales we made this year. The other concept that we're going to talk about is conservatism. Our accounts receivable that we're going to report in our balance sheet is $98,000. Even though we have $100,000 sitting in our accounts receivable, we know that some amount will be uncollectible. So we're going to report a more conservative amount. And this relates to the conservatism principle. Rather than report accounts receivable at $100,000, a more conservative amount is going to be $98,000 because we think we cannot collect the full $98,000 or the full $100,000. So we're going to report it at the conservative amount of $98,000, a lower amount. We don't want to overestimate our assets. And so that's sort of a summary, a very brief example of what we're going to do today. Now, at the bottom of page 1 on your handout, this is sort of a good summary to keep in mind. These are the 3 types of journal entries we're going to be doing. We're going to estimate our bad debts expense at the end of the year. Now, remember, that's just an estimate. Whenever we determine that a specific customer is not going to pay us, we're going to write off their accounts receivable. That's the middle journal entry. But what could also happen is, let's say we write off a specific customer's accounts receivable, and then later on they pay us. And that's the third journal entry, is that what if we recover an amount that was uncollectible that we had previously written off? And so just sort of keep this in mind as we go through chapter 9. This summary on the bottom of page 1 is a good summary of the new types of journal entries that we're going to be doing in Chapter 9. So let's move on to page 2 and talk about how we can estimate our bad debts expense. Remember, we said that at the end of the accounting period, when we're doing our adjusting journal entries, we have to estimate our bad debts expense. Now, one of the methods is called the percentage of sales method. And all we do is we take all of our credit sales and multiply it by a certain percentage. So let's look at this example here. Let's say our credit sales for the year was $500,000. Now, we estimate that 2% of our credit sales will be uncollectible. So then all we have to do is take 500,000 times 2%, and that's going to give us the amount of our bad debts expense. And so we work that out, that's going to be $10,000. So our adjusting journal entry to record our bad debts expense will be debit bad debts expense 10,000, credit allowance for doubtful accounts 10,000. Now this allowance for doubtful accounts, what I refer to as our ADA account, in some textbooks they use the term allowance for uncollectible accounts, or AUA. Now this textbook uses the term allowance for doubtful accounts, ADA, but other textbooks may refer to this contra account as allowance for uncollectible accounts, AUA, but essentially it's the same thing. Now I want to practice using the percentage of sales method by looking at starter 9-2, 9-3. So turn to page 521 in your textbook and let's look at starter 9-2 first, and then also 9-3. They're connected. So pause the video here, turn to page 521, read through 9-2, 9-3, and then we'll work through these together. So pause the video now to read the questions first. Now looking at 9-2, we have this company, Spring Break Travel. They've earned revenue of $700,000 on account, and at the end of the year, their accounts receivable is $80,000. And they're going to use this allowance method, and that's what we're focusing on, is what we refer to as the allowance method, to record their bad debts expense. Now, they estimate that 1% of their revenue will be their bad debts expense. And so let's just sort of set up what we know here. Currently, they have accounts receivable sitting there of $80,000. And now at the end of the year, we have to do our adjusting journal entry. So at December 31st, we have to figure out what's going to be our adjusting journal entries. And using the percentage of sales method, all we're going to do is take their total sales, total credit sales of 700,000, multiply that by the percentage that they're given us, which is 1%. And so we're going to estimate their bad debts expense to be $7,000. So then our adjusting journal entry is we're going to debit bad debts expense by $7,000, and then the credit goes to that new account called allowance for doubtful accounts of $7,000. And once again, allowance for doubtful accounts is a contra account to accounts receivable. So we're just going to set that up beside accounts receivable. And it's basically going to be connected, so we can't separate the two. Now, the bad debts expense is going to go to our income statement, and the allowance for doubtful accounts will go onto our balance sheet, and which is going to reduce our accounts receivable. Now, that's part one of the question. Part two of the question says, how will they report their accounts receivable on their balance sheet? So on the balance sheet, what we'll see is under current assets, we'll see our accounts receivable of $80,000 less the amount of the allowance for doubtful accounts of $7,000. So the amount that we're going to show on our balance sheet is our accounts receivable net of $73,000. So ultimately it will be the $73,000 that gets added to our current assets on our balance sheet. So that is 9-2. Now I'm going to look at 9-3, which is a continuation. So 9-2 happened in 2019. So that all happened in 2019. Now we're going to move to 9-3, which focuses on 2020. Now, we're going to take these balances and we're going to forward them to 2020. So at the beginning of 2020, we're going to have accounts receivable of 80,000. Our allowance for doubtful accounts is 7,000. So that's what we have at the beginning of 2020. So then have a look at 9-3 and let's go through what happens in 2020. They have service revenue on account, they collect money on account, they do some write-offs, and then they record the bad debts expense at the end of 2020. Now they want us to do journal entries for these transactions, and we're also going to update the T accounts as well. And once again, actually, this is only for the first quarter of 2020. So this is from January 1st to March 31st. So let's look at the first one. Let's do the journal entry for service revenue on account. So we know that we're going to debit accounts receivable for 800,000. And we're going to credit our service revenue for 800,000. So that's the first journal entry. So we're going to increase our accounts receivable by 800,000. Now the next journal entry is we're going to collect some of that, and the amount we're going to collect on account is 840. So we're going to debit cash for 840,000, credit accounts receivable for 840. And so let's just update our accounts receivable. Now the next one is write-offs of uncollectibles. Now this is going to be a new journal entry. We want to write off a specific accounts receivable. Now, remember this 7,000 that we set up at the end of last year? This was set up at the end of last year. This was at December 31st, 2019. What that represents is the amount that we think will be written off in 2020. So we think that in 2020, remember this is just an estimate, that we're going to be writing off 7,000 of accounts receivable. And so when we write off a specific set of accounts receivable, the journal entry is we're going to debit our ADA account. And once again, we're only going to write off 6,000 because that's the amount we are actually determining to be uncollectible. And we're going to credit our accounts receivable. Now we're going to take out the 6,000 from our accounts receivable that we have a really good idea that we're never going to collect. And so debit our ADA and credit our accounts receivable. And what this means is that we're still going to be left with $1,000 credit balance in our ADA. Remember, we estimated that 7,000 going into 2020 of our accounts receivable was going to be uncollected. In actual fact, only 6,000 was uncollected. So we're going to be left with this $1,000 balance here. Now, which is fine because remember, the estimate that we made at the end of last year, that 7,000, was purely just an estimate. We don't know exactly how much is going to be uncollected until we get into 2020. And it turned out that only 6,000 was uncollected. So it's okay to have this small balance left over. It just means that we overestimated. We thought it was going to be 7,000, ended up only going to be 6, and so we're left with this small balance of $1,000. That's perfectly okay whenever we make an estimate. And then we get to March 31st. And once again, it's likely that this company is doing quarterly financial statements. So at March 31st, at the end of the first quarter, they're going to do their adjusting journal entries before they prepare their financial statements. So now they have to estimate, well, what's the bad debts expense for the first quarter of 2020? And it's estimated to be 1% of their revenue. So their revenue again was 800,000. So 1% is going to be 8,000. And so to record the bad debts expense for the first quarter, they're going to debit bad debts expense for 8,000 and credit their allowance for doubtful accounts for 8,000. And so once again, if we update our T accounts, at the end of the first quarter, our allowance for doubtful accounts will have a balance of 9,000 credit. And if we look at our accounts receivable, if we work through all that math there, we're going to be left with a balance of 34,000. Now on the balance sheet then, so on the balance sheet at March 31st, let's just show what our accounts receivable will say. So the balance sheet at March 31st, for our accounts receivable, we're going to have a balance of $34,000 less the allowance for doubtful accounts of $9,000. So our accounts receivable net is going to be $25,000. That would be the amount that will show up on our balance sheet under our current assets for accounts receivable. So that's an example of how the percentage of sales method works when it comes to estimating our bad debts expense. Now, there are other methods. There's two other methods to estimate the bad debts expense. So let me just get this cleaned up. And then once we have this cleaned up, we're going to go back to page 2 of our Chapter 9 handout. And let's look at the next method. So the first method that we just looked at was the percentage of sales method. Let's go back to page 2 of our handout. And let's look at the next method. The next method is called the aging of accounts receivable. And there's a good example of this on page 498. Now, this one actually looks at how many days has a specific accounts receivable been outstanding. And the premise is the longer that it's been outstanding, the less likely is we're going to collect it. So the ones that have been outstanding for, let's say, over 90 days, there's a greater chance that we're not going to collect those. The ones that have been outstanding for less than 30 days, there's a greater chance that we will collect those. So we're going to work through exercise 9-5. And once again, find that in your textbook. Pause the video here before to read the question and then resume when you're ready. So pause the video now to read exercise 9-5, page 526, 527. Now let's have a look at exercise 9-5. Now in this question, we're given the information at the end of 2020 before we have made any adjustments. So let's actually just draw those T accounts. So let's just draw those T accounts for exercise 9-5. So exercise 9-5, we know that our accounts receivable is $300,000. And currently in our allowance for doubtful accounts, we have a balance of $8,900. Now this is before our adjusting journal entries. Remember we said in the earlier example that we're going to have some balance in our allowance for doubtful accounts because when we set it up at the end of the previous year, that was just an estimate. And when we write off specific accounts receivable, it's very unlikely that our estimate at the end of last year was going to be right on. So we're going to be left with this small credit balance before we make our adjusting journal entries for 2020. Now, in this example, we're going to use the aging method. And so the aging of accounts receivable method, if you look at the schedule at the bottom of page 526, our total accounts receivable is $300,000, but it's broken down into how long they've been outstanding. We have $140,000 that is less than 30 days old, and we estimate that 0.5% of that amount is going to be uncollectible. So 140,000 times 0.5%. So when you put that in your calculator, it's going to be 0.005. So 140,000 times 0.005, that's 0.5%. That's going to give us $700. So of 140,000 in accounts receivable, we think that only 700 will be uncollectible. Then we go to the next one. The 80,000 has been outstanding between 31 and 60 days. So the percentage has increased because it's been outstanding longer. So there's a greater chance we're not going to collect those amounts. And so we estimate that out of the 80,000, 1,600 will be uncollected. And then we just continue on. In the next column, 70,000 times 6%. And then in the final column, 10,000 times 50%. And if we add up these numbers, this is going to give us a total of 11,500. And once again, all this is saying is that of the 300,000, of this 300,000 in accounts receivable, we estimate that 11,500 is going to be uncollected. So this number represents what we want in the ADA account at the end of the year. Out of the $300,000 in accounts receivable, we estimate that $11,500 will be uncollectible. So we want our balance sheet to show this. We want our balance sheet to show the full accounts receivable less the amount we think will be uncollected. And so our accounts receivable net on our balance sheet at the end of this year should be $288,500. Well, this is a little bit different from the percentage of sales method. The percentage of sales method, the number that we calculated was in fact the amount of our bad debts expense. In this example, this is a little bit different. When we do our adjusting journal entries to record our bad debts expense and the adjustment to our ADA account, the adjustment that we're going to need is this missing number here. Currently, our ADA has a credit balance of $8,900. We want to end up with $11,500, so the amount of the adjustment we need is going to be the difference between those two numbers, which is $2,600. So our bad debts expense, debit $2,600, our allowance for doubtful accounts, credit $2,600. Now, once again, this method focuses on the specific balance in our accounts receivable, and it breaks it down as to how many days it's been outstanding. And the premise is the longer it's been outstanding, the less likely it is we're going to collect it. So in some respects, accountants view this method as a little bit more accurate because we're actually analyzing each of the specific balance amounts that customers owe us. And so that would be the answer to part one. This is the answer to part one of the question. Journalize the adjusting journal entry. And then the answer to part two would be over here. What is the balance in accounts receivable? That's going to show on the balance sheet. Now, we look at part three of the question. It just says, assume the same facts, but instead of this balance being $8,900 debit credit, let's say it was $900 debit. So let's actually set up part three now. Let's say we're going to go to part three of the question. Our accounts receivable is still $300,000, but our allowance for doubtful accounts now has a small debit balance of $900. So it's on the other side. We still want to end up with $11,500 at the end of the year based on our aging schedule. So then the question is, what is the amount of our adjustment now? Now this one's a little bit different. We're still trying to figure out this number here, but now we have a debit balance. So to get from a debit balance of $900 to a credit balance of $11,500, what is that missing amount going to be? Well, it's going to require an adjustment of $12,400. So our adjusting journal entry is going to be a debit to bad debts expense of $12,400 and a credit to our allowance for doubtful accounts of $12,400. So once again, using the aging method, we figure out what the target balance in our ADA account should be based on the aging schedule, but the amount of our adjustment is the missing amount that's going to get us from the unadjusted balance to where we want to be. So that's the difference with the aging approach. Now, there's also one final approach, and we're going to look at that next, but I'm just going to get this cleaned up before we go back to our handout. So let's go back to our handout then, and let's look at the final method. Now, the final method on the bottom of page 3 is called the percentage of accounts receivable method. And the percentage of accounts receivable method just basically takes your accounts receivable method and multiplies it by a percentage, and that's also going to be the target balance in the allowance account. So let's have a look at starter 9-4. Now, once again, pause the video, turn to page 522, and have a look at starter 9-4, and then once you're ready, resume the video. So let's have a look at starter 9-4. Now, starter 9-4 is focusing on what we call the percentage of accounts receivable method. And so let's just set up the information that we know so far. Now in Starter 9-4, this is at the end of 2020. Now, we're told that at the end of 2019, the accounts receivable balance was 2020. So that was, $20,000. That was at the end of 2019. At the end of 2019, the accounts receivable balance was 20,000. Now, during 2020, they earned revenue of 454,000 on account. So that would be increased to our accounts receivable. They collected 325,000 of that. So they collected 325. And they also wrote off 5,600 in receivables as uncollectible. Now, we're going to look at part one first. Now, in part one, the allowance for doubtful account at the end of 2020 had an unadjusted balance of 2,700. So that's sort of where we're at. We're at sort of this section right now. Sorry, they also wrote off 6,000, so that 6,000 would show up there. Now we're assuming that the journal entries have been done, so all we're doing is just looking at the impact to the T accounts. Now this 6,000 here, that would have been a debit to the allowance for doubtful accounts and a credit to accounts receivable. We're assuming that that has already been reflected in this 2,700 December 31st balance. So we're saying that at December 31st, the balance in the allowance for doubtful accounts is 2,700, and the balance in accounts receivable, if we work through the math, is 143,400. And now all we have to do is to record the adjusting journal entry for our bad debts expense. And when we use the percentage of accounts receivable method, all we take is the percentage that they've given us. And so the percentage that they expect that will be uncollectible is 5% of the accounts receivable balance. So then all we do is take the accounts receivable balance, multiply by 5%, and the 7,170 is also going to be the target in our allowance for doubtful accounts. Remember, we have accounts receivable of 143,400. We expect 5% will be uncollectible, so the balance in our ADA should be 7,170. Now the question is, what's going to be the amount of our adjusting journal entry? And once again, if you work through the math, we're going to get an amount that's going to bring us from 2,700 to 7,170, and so the adjustment needs to be 4,470. So our adjusting journal entry is going to be a debit to our bad debts expense, 4,470, and a credit to our allowance for doubtful accounts, 4,470. So that would be the adjusting journal entry for part one of the question. Now, part two of the question basically looks at the same thing, except in part two, we have a different opening balance or a different balance in our ADA account. So let me just get this cleaned up. So in part two, the only difference now is the balance at December 31st in our ADA account before we make our adjusting journal entries is now going to be a debit of 2,400. So assume that the unadjusted 2,400 debit balance in allowance for bad debts or allowance for doubtful accounts is 2,400 debit. So then we got to figure out, well, what is the adjustment that we need? How do we get from 2,400 debit to 7,170 credit? We're going to need an adjustment of 9,570. So for part two of the question, our adjusting journal entry is going to be a debit to bad debts expense, 9,570, and a credit to our allowance for doubtful accounts of 9,570. So that's an example of how the percentage of accounts receivable method works. The number that we calculate, again, is the target balance in our allowance for doubtful accounts. So let's move back to our handout. And the textbook also talks about this method called the direct write-off method. That is not that common. And once again, you can read through that on page 503 and 504 on your own. Moving on to page 3, we're now going to go to credit card sales. And so if we think about credit card sales, we're going to get the cash up front from the credit card company. And it's the credit card company that's going to have to collect the money from the customer. And credit cards usually charge a fee, and the fee is usually between 1 and 3% of the sales that are made on the credit card. So let's just actually look at an example here. Let's say the credit card sales was $10,000 for the day. And the fee that the credit card company is going to take is 1%. So their fee is going to be 100. So in our journal entry, this is what we record. Our sales revenue is the 10,000. The amount of cash we're going to get from the credit card company, usually at the end of the day or the following day, is going to go directly into our bank account of 9,900. And the expense, the credit card expense, is going to be 100. So we're still going to record sales revenue of $10,000, but the actual cash we're going to get from the credit card company is only going to be 9,900, and we're going to have an expense of $100. That's the fee we pay the credit card company. Now, debit cards work the same way, but usually for debit cards, it's based on each transaction. And so once again, let's just say we have $10,000 in sales revenue, but let's say that's based on 200 transactions. And let's say the bank that the debit card is being used from charges us 5 cents per transaction. So if we have 200 transactions and the bank is going to charge 5 cents per transaction, then that's going to be a total of $10. So our sales revenue is still going to be credit sales revenue 10,000. Now we're going to have to pay this fee of $10. So the cash we're going to get from the bank is 9,990, and our debit card fee is going to be $10. That's our expense. And so that's what happens with credit card and debit card sales. We still record the full amount as our sales revenue. However, the cash amount that we get is going to be less the amount of the fee that we have to pay the bank or the credit card company, and that fee amount is going to be a new expense. So that's how credit card sales and debit card sales are recorded. Now we're going to move on to a new receivable called notes receivable. Now, I want you just to take a minute and read through this paragraph here. So pause the video while you read through this paragraph, and then we'll go through the journal entries together. We'll look at this example together. Now, we are ABC company, and we're going to loan $40,000 to another company. And so we are basically known as the payee. So ABC company is known as the payee or the creditor. So they're going to loan $40,000 to another company, and this other company is going to be the borrower. So we're going to focus on the journal entries for ABC company. Now we're the payee or the creditor. We're going to have a notes receivable, and the borrower is going to have a notes payable. Now this note is going to be paying interest of 3%, and the amount of the note and the interest is going to be due 1 year later. So on the day that we make the loan, we're going to debit this new account called notes receivable. Now once again, notes receivable is an asset, and we're going to credit cash for the $40,000. So that's the amount we're loaning to this other company. And then we get to the end of the year, December 31st of 2020. And this is where we have to do our adjusting journal entries. And if you think about this notes receivable, we're charging interest of 3%. Now we're not going to worry about compound interest. We're just going to worry about simple interest. Now, if you think about the interest for the whole year, is going to be 40,000 times 3%. So the total interest for the whole year is $1,200. That basically works out over 12 months. So it works out to $100 per month. Now at December 31st, the purpose of this adjusting journal entry is to accrue 4 months of interest revenue. Because interest accrues on a daily basis. So from September the 1st to December 31st, we would have earned 4 months of interest or $400. But remember, we're not going to get paid until next September the 1st. But because accounting says once we've earned the revenue, we have to record it, even though we're not going to collect the cash till later, we have to record the 4 months of interest revenue. Now, we know that whenever we record revenue, we're going to credit that account. So we're going to credit interest revenue for 400. The question is, what do we debit? Well, we're not going to debit accounts receivable because accounts receivable is reserved for the amounts our customers owe us. So we're going to set up this new receivable account called interest receivable. And interest receivable is going to be an asset account, just like notes receivable. And that's the amount that the borrower owes us in terms of interest at the end of December 31st, 2020. Now, when we get to September 1st, 2021, we have to think about what that journal entry is going to be. On December 1st, 2021, we're going to get back the $40,000 plus the $1,200 interest. So the amount of cash we're going to get is $41,200. So we know that the cash we're going to get, debit cash, is going to be $41,200. Now we got to figure out, what do the credits go to? Well, if you think about this, let's look at our TUT accounts. We have notes receivable sitting there of $40,000, and we also have interest receivable sitting there for $400. Now, after we get paid, what should the balance in these two accounts be? Well, the balance should go to 0. Well, how do we get them to 0? We're going to credit notes receivable for $40,000 and credit interest receivable for $400. So let's add those to our journal entry. We're going to record the interest receivable, credit $400, credit notes receivable, all for the $40,000. But we're still out $800. What does this $800 represent? Well, if you think about it, that's the $800 of interest that we earned this month. So remember, last month we recorded 4 months of interest. So this month we're going to record the remaining 8 months of interest. So that would be the final journal entry when we actually collect the note plus the interest. Moving on to the last page, the last topic we're going to look at is sum ratios. And in this chapter, we focus on 3 ratios. The first one's called the asset test or quick ratio. Now, it's very similar to the current ratio. The only difference is, rather than taking all the current assets in the numerator, it's just going to be cash, short-term investments, and the accounts receivable, the net accounts receivable. And then we divide that by the total current liabilities. Now, with the ratios that we've looked at in the past, we have to identify whether a higher or lower ratio is generally better. The asset test or quick ratio, generally speaking, a higher asset test or quick ratio is better. Now, in the textbook on page 512, they say that usually if this equals 1, an asset test or quick ratio around 1 or higher is generally going to be a safe ratio. Now, the two that relate to accounts receivable are days sales and receivable and accounts receivable turnover. Now, days sales and receivable calculates the number of days it takes to collect our accounts receivable. Now, obviously, we want to reduce that, right? We want the number of days it takes to collect the accounts receivable to be lower. So days sales and receivable, lower is generally going to be better. With accounts receivable turnover, it calculates the number of times that we collect our accounts receivable each year. And we want to increase that. We want to be collecting our accounts receivable more times a year. So the accounts receivable turnover, higher is going to be better. Now, we'll go through the calculations together, but we're going to look at this exercise to do the calculations for these two ratios, the two accounts receivable ratios. So have a look at 9-13, page 529. Now, when it comes to days sales and receivables, we have to sort of do this in 2 steps. So exercise 9-13. The first step is to calculate 1 day of sale. And when you look at 9-13, we're going to calculate the days sales and receivables for 2019. And so we take the net sales, and once again, the net sales or the net credit sales is 594,920, and we divide by 365. And if we take that number, and let's just round this to 4 decimal places, just because we want to carry over a few extra decimal places. 1 day of sale is going to be 1,629. And let's just round it, like I said, to 4 decimal places. And then what we're going to do is we're going to take that number as the denominator, and we're going to take average net accounts receivable as the numerator. Now, average net accounts receivable is just basically the average of the accounts receivable at the end of last year plus the amount at the end of this year divided by 2. So let's work on the numerator first. We're going to take the accounts receivable at the end of last year, 47,100. We're going to add the accounts receivable at the end of this year, 38,500. Divide that by 2, and then divide it by the 1 day sale, the 1,629.9178. So just sort of work through that calculation. And what you'll get is the average accounts receivable is going to be 42,800 divided by the numerator. And that's going to give us days sales and receivable of 26.26 days. So all we're saying is that it takes this company around 26 days to collect their accounts receivable. Now, the other ratio, the accounts receivable turnover, this one here, we take their net credit sales for the year. And so this company has net credit sales of 594,920, and then we divide it by their average accounts receivable. Now, their average accounts receivable, we determined that earlier to be 42,800. And so this is going to tell us the number of times they collect their accounts receivable during the year. And if we work through that, it's going to be 13.9 times. Now, there is another way of calculating this 13.9 times, is we can take the days sales and receivable and just go 365, divide it by 26.26, and that's going to give us our accounts receivable turnover as well. And so all we're saying again is that we can express this one of 2 ways. We can use the days sales and receivable. It's going to take us 26 days approximately to collect our accounts receivable. Or we can also say that we collect our accounts receivable on average about 13.9 times a year. Now, in order to determine whether this is good or bad, this is where we get to part 2 of 9-13. When you look at part 2 of 9-13, it says that their credit terms are 210, net 30. What this means is that they give their customers 30 days to pay off their balance owing. And so what we can do is compare that to the days sales and receivable of 26.26 days. And then we can assess whether this is good or bad. Well, this is actually fairly good, right? All their customers are generally paying on time. So this is usually a good sign. They're paying within the 30 days. It's taking them on average 26 days. So that generally is a good sign. Now, the reason that this 26.26 is less than the 30 is that some of the customers are likely taking this discount of 2% by paying within 10 days. So usually we compare it to the credit terms, and if it's below the net number of days, which is 30 days in this example, then that's generally a good sign. Now, just to wrap up this chapter, this is a good exercise to do on your own. So I posted the solution of 9-21 in D2L Brightspace, so do that on your own. And that brings us to the end of this chapter 9 tutorial on receivables. Good luck with your studies. We'll see you in the next chapter tutorial.